Welcome back to another video. If you're new here, hit the subscribe button. We're going to talk about stocks, options, stock market, everything. And if you've been supporting, thank you so much for the support. I really appreciate it. Continue to share, like, comment, and let's grow this community. I'm right now in the middle of a 5K account challenge, and the account now is at 12K about. I'll talk more about that later, but this video is about risk management. And I have come across one of the best formulas that you could use for risk management. This might be the most important options video that you will ever watch. All right, let's get started. Nothing was more frustrating to me on my trading journey with options than not knowing how much I would lose if the stock went against me. Not knowing the premium, how much would the premium get taken, like how would it take a hit? In what way? How much would the option decrease by if the stock dropped? Finally, after years and years and just months of just doing it the wrong way, I found it out. A couple months ago, it just clicked, right? So after just looking at the formula for a little bit, boom, I was able to combine two steps, and then it became so simple after that. So check this out. This is absolutely going to be game changing. And this formula works, and it's more accurate the shorter the trade and the smaller the spread. So if you're trading something with wide spread in terms of options and you are holding longer, especially short-term expiration, this is not going to be as accurate. But the quicker you're in and out and the smaller the spread that you're playing on the option, this is going to be gold. I recommend, if you're going to play same week expiration, try not to hold longer than 20-30 minutes, right? Now, let's get into the risk management. Now, let's just say somebody's starting out with a 10K account, right? Nice round number. Now, if somebody's starting out with 10K, ideally, you don't want to lose more than 2% of the account, right? 2% loss on, let's say, one trade. And there's a big reason you want to keep that number small. Just really quickly to go over that. If you risked 100% on one trade, then you only have to be wrong one time, and that's it, you're done. And the probability of that is very high. If you risk 50% on a trade, then you only have to be wrong 2 times. The probability is less likely than the first one, but it's still very, very likely. It's very, very likely to be wrong 2 times in a row. That's normal. If you risk 30%, same thing, 3 trades and you're out. If you risk 10%, 10 trades and you're out. So if you think about it, the less percentage you're risking per trade, the more times that you'd have to be wrong in order to, blow up your account, in order to lose money. So it would make sense to keep the percentage as low as possible. Consider even dropping it all the way down to 1%. Now, people say, I'm trading options. How can I do that? Here is how you can do that. You have 10K in your account, and let's say your max loss is 2%. So technically, your loss on that is $200. So you're willing to lose $200 on a trade. What most people do is just they obsess so much over this $200, right? That's what they're going to lose. Again, that's not what they're going to put in. That's just what they're going to lose if the trade hits their stop loss on the chart. So instead of thinking about this $200, what I want you to do is just divide it by 50. So just picture this right here. Picture that your max loss on one trade is $200, and then we'll continue the example from there. We divide it by 50, and I'll explain that maybe in another video, but for now, let's see an example of it. You divide it by 50, you end up with 4. So 4 is actually now our risk number. What's a risk number? It's just a risk number. It's not a dollar amount that you're risking. It's just a new term. It's called risk number. Okay, what do I do with the risk number? Why is this number special? Very simply, the risk number is the number that you have to have in your head anytime you're about to enter a trade. You're about to enter AMD calls or puts, 4. Think of 4. You're about to enter Tesla, or you're thinking about it, or you see a play there, just think of 4, right? That's the first step. Now, the second thing you have to know is, where am I going to get out on the chart, right? Which is the stop loss. So, for example, if there's a level of 50 and then there's another level at 48, technically here the stop is $2. Some people call 48, that's where my stop is. just for simplicity's sake, we're going to call the stop how far it is from my entry. So if I'm getting in at 50 and then getting out at 48, my stop, I'm going to say it's $2. So what you do here is very simple. You take your risk number and then you divide it by your stop, right? You divide it by your stop loss. And then what does that give you? Very simply, that gives you the number of contracts to buy. Very simply. Which contracts do you buy? You can go at the money. And just a little hint, this 50 was because you're playing a delta of 50. And everything at the money is around 50 delta. So that's a little trick there. But you don't have to, distract yourself and confuse yourself with all this math. All you have to know is very simply, you just have to know one thing. And that one thing is what's going to make you a professional. And that one thing is the stop loss. Forget about everything else. Yeah, you heard about stop loss before. Yeah, I heard it. But are you applying it? And this right here is the simplest way to apply it if you're trading options. How do I know this? Because I made the formula up myself. And it's been helping me like crazy. Other than when I get emotional and just start averaging down, doing some, stupid stuff. But if you follow your rules, this is going to make everything so much simpler. You take your risk number and then you divide it by 2. Why 2? Because in that scenario, the stop loss was $2 away. And then the answer is 2, so you automatically could just go and buy 2 contracts. And then if, technically speaking, right, if you buy those 2 contracts here and then you sold them here, you're going to lose about $200. Okay? And I'll show you an example of that on Thinkorswim in a second. So let's give another example. Let's say your max loss was 500, right? So now technically your risk number is not 4. Your risk number is now what? Now you got to divide by 10. Brain fart. You still divide by 50. You always divide your max loss by 50 and that'll give you the risk number. So on this trade, if somebody's risk number was 10, and then the stop loss was $2 away, they can actually buy 5 contracts. Because when they buy 5 contracts here, and then they sell it here, they're going to lose about $500. Okay, and again, I'm going to give you an example of that in a second on Thinkorswim to see does this actually work or not. So let's say we just come up with a whole new example, whole new idea. So you're watching a stock here, breaks out there. You say, okay, I'm going to get in here at 60. I'm going to sell here at, 56. All right, $4 stop. So now what's my risk number? To know your risk number, you just have to know what your max loss is. So let's say somebody's max loss is $100. So risk number is 100 divided by 50, right? Because of the delta. And then that's 2. And that is 2. So 10. Oops. Your risk number is now 2. Now here, you're dividing by 4. So my risk number is 2. My stop loss is $4 away. Now, this comes out to 0.5. Can I buy half a contract? No. So what this means, when you do this formula and then it gives you the answer as less than 1, you can't even touch that contract. Because if you touch that contract and then it goes to your stop loss, you're going to lose more than your initial max entry, than your initial max loss, excuse me. Does that make sense? So, again, really quick example. Again, say you're entering at 510, your stop loss is 500, for example. And let's say your max loss is $400. 400 divided by 8, divided by 50 is 8. And then divided by, since the stop loss is $10 away, stop loss divided by 10, it's less than 1. So boom, you can't even get one contract because 8 divided by 10 is going to be less than 1. If it was an $8 stop loss away, right? Now you'll be able to buy one contract because 8 divided by 8 is 1. So what most people do is they understand that this level is the best level to have the stop loss. But what they end up doing, which is not the best idea because it ends up in low probability trades, is that they end up raising their stop loss and selling it closer, where it's like it has a higher chance of getting hit. They don't want to lose as much, but they're basically giving money away. Because when you place your stop loss too tight, because of the money factor, that's never going to work out long term, right? You need to look at the stop loss first and then have the money factor correspond on that. So you create your stop loss first, and then that'll tell you how many contracts to buy. Most people, they say, okay, I want to buy this amount of contracts without even thinking about their risk or without even thinking where the best stop loss would be. So for example, they say, I want to get 5 contracts on Tesla. And if Tesla comes down, I don't want to lose more than $500, And if you have a Tesla Delta of 50 times 5, because you got 5 contracts, that's 250. So all that has to happen for that person that gets 5 contracts of Tesla, all that has to happen for them to lose 500 is Tesla has to move $2. Now, for me, that's a pretty tight stop loss, right? If I want to risk $500, first thing that comes to mind is I can't get 5 contracts, right? I hope that makes sense. So let's go look at it in Thinkorswim. Let's take Square, for example, and we go on any of these days, March 16. And then we'll find any, $2 move or whatever, and then we'll calculate it from there. Say you entered at this open, and then the stock went up about, say, $3. So from 940 to 950. So let's go to 940. Now let's say, and I'm just going to work backwards here so you can see it in real time. So 940 hits. Let's say for whatever reason, I want to short this right here. I think it's too extended or whatever the case is. So now let's say I want to short Square by playing puts at this level of 106, and then I'm going to get out at 109. Or let's just to make it, more even, right now it's at 106.60. Let's say I enter here exactly where it is now with a $3 stop loss. So technically, my stop loss will be 109.6. So that's what you have to think of as a trader, right? Because we already know what our risk number is, right? You should be risking the same exact number every single time. So me, for example, ideally, I don't want to lose more than $200 on a trade, right? On this account challenge, 5K account challenge that I'm doing. So if you do 200, my risk number is 4 because you take 200 divided by 50. So when my risk number is 4, think about it like this. You divide it by the stop loss, right? So since my risk number is my max loss, which is 200, and I'm dividing it by the delta, now all I got to worry about is 4. I don't got to think about 200 anymore. I don't got to think about the delta. I can play at the money, out the money all day, right? So 4. Now my stop loss, like we determined here, is $3 away. Okay, so that's more than 1. Technically, I can buy 1 put at the money. And if Square goes to 109.6, I'm going to lose about 150 to $200. Let's on demand that and let's see what happens. We go here, we'll play it. Now let's say we go, and keep in mind that you're gonna lose that 150 or 200 at the money any expiration you play, because if you see any of the at the monies, they're all about the same delta. Okay, so let's say we stay here and then we play the put, right? Go right here and then I'll just buy it. So right now we're in one put of square, and what I know, because we already know what happens, 10 minutes later, is that square pushes $3. So right now we're in the put. Ideally, when this loads, I should be down, 150 to 200 bucks, since it went up about $3. And it's gonna reflect right here when it's done loading. So now as we're waiting, technically speaking, if I got 2 contracts, it would have doubled the loss, right? See here, 131. Now let's say instead I didn't even do any calculations and I just said, you know what, screw it, I'm just gonna buy 3 contracts. Had I bought 3 contracts for no reason whatsoever, in terms of risk management, let's say I bought 3 instead, now I have 3 square contracts, right? Now if I, again, say my stop loss is $3 away, but I didn't do any of the calculation, now I'm gonna be down 3 times as much. So instead of being down 130, I'm down almost 370, 380. So that's super important. Let's do another quick example. This time we'll do it with the calls, and then it going against you with the calls. Let's say AMD. Let's say you try to short here, for example, and then it goes against you about $5, right? About $5-6. All right. So we'll go here, 950 of the previous day. And then let's give a whole new example. Let's say somebody's max loss is 500. And that means that their risk number is what? The risk number is 10. Now, let's say I wanted to leave let's see where the stop loss would be, first of all. How do you go back? Okay, mouse. Skip here. About $5-6. So 1045, 950 to 1050. Yep. And my stop loss was, above, not that 3. Let's say it was above $3, even higher. Let's say it was $6 away. So what you're gonna do is, quite simply, your risk number was 10. You're dividing by 6. Again, you can get 1, maybe 2 contracts, maybe, because it's like almost there. So let's calculate. Let's see what happens if you buy 2 puts at that point. All right, you're shorting. You're thinking, AMD is gonna crash, and then before you know it, it just pushes up $6. $5-6. And look how much you're down, right? So you're staying within that loss. You're not exceeding your loss. It's staying between, it's either 5, it's gonna be somewhere around 500, maybe a little bit under. Here it's pulling back, 40 cents. At the high, it probably would have been just about that. So here, for example, let's say you go to 1050 on the dot. Let's see how it was there. Boom, yeah, close to 400. So this is how accurate it could be. But instead, if you get 4 contracts there, right? We go back to 950, and again, 2 contracts was going for $300 each. So if you said, oh, let me just put in 1,200, that's okay, I'm good. But then look what happens. Your loss doubles. Instead of $300-400, now it's $700-800. And the reason is because you didn't do the formula, so you didn't keep your risk intact. I hope this helped. If you have any questions, please let me know. And if any question that you have, I would love to help. One favor though, please, if you can, share this with one more person. Just trying to get to over 1,000 subscribers as soon as possible. So if this has been helpful to you in any way, please go ahead and share it with a friend. It just might save their trading career. All right. Thank you for joining, and see you tomorrow on the next video.